Welcome to the Denison Diversified Property Fund End of Year Financial Presentation. I'm Matthew Burrows, the CEO of Denison, and I am pleased to present to you what I believe is a great financial year result for 2015. In addition, I'll be touching on the fund's financial position and fund operations. I will also discuss the fund's portfolio allocation post 30 June 2015, as well as a strategy for DDPF and the outlook for the fund. Throughout financial year 2015, Denison have had successes in three key areas. Net asset value increased unit price from 46 cents per unit to 60 cents per unit, resulting from the revaluation of the DDPF portfolio and sale of 11 Queens Road and 34 Chandler Street. Capital management, a reduction in fund gearing from 78.4% to 71.3%. The successful refinance of the first mortgage on Mirrabooka with a margin reduction from 2.75% to 2.25%. The successful sale of Artarmon at a net price of $16.1 million, which equated to a 19% premium to book value and a 68% premium to the purchase price. Asset management, the execution of 15 new leases totalling over 3,085 square metres. High tenant retention of 19 tenants totaling 21,472 square metres. This equates to an 80% retention of total expiry for the financial year ending 30 June 2015. An improved weighted average lease expiry from 3.3 to 3.7 years. The fund snapshot gives you a clear indication of the fund's positive performance from financial year 2014 to financial year 2015. Net asset value has increased from 48.86 million to 62.83 million, an uplift of 29%. The increase in unit price can be attributed to the revaluation of the DDPF portfolio and asset sales. The revaluation of the portfolio increased DDPF to 232.7 million, which equates to a 9% value uplift. The total number of properties has decreased to 17 after the successful sale of two assets during the financial year, being 11 Queens Road and 34 Chandler Street, both at above book value. There has been an increase in the WALE as a result of the execution of new leases and high tenant retention. Some of the major lease deals during the financial year included Optus at 2 Apollo Place, Lane Cove, New South Wales for 3,995 square metres, Raytheon at Munster, Western Australia for 3,000 square metres, Optus at Mulgrave, Victoria for 2,963 square metres, CMAX Cinema at Devonport, Tasmania for 2,556 square metres, New South Wales Department of Community Services at Shell Harbour, New South Wales for 1,318 square metres. The overall fund gearing level has reduced from 78.4% to 71.3%. This is a result of the execution of targeted asset sell-down strategy and debt reduction. This strategy complements the overall capital management strategy to refinance DDPF's current debt to take advantage of the current low interest rate environment. DDPF's property assets have reduced from last financial year as a result of the sale of 11 Queens Road and 34 Chandler Street. The fund's interest-bearing liabilities have also reduced to 173 million as a direct result of the asset sales throughout the financial year. The interest-bearing liabilities are divided between senior at 127 million and mezzanine at 46 million. The unit price has increased 14 cents or 30% from last financial year to 60 cents per unit as a result of the uplift in property values and aforementioned property sales. However, I would like to address that this unit price is on an undiluted basis. It should be noted that DDPF issued warrants in the fund to FARI 3 during the June 2012 recapitalisation strategy. These warrants convert to ordinary units in the fund on a 1-to-1 basis and represent 30% of the issued units of the fund. As such, on a fully diluted basis, the unit price is 42 cents per unit. Upon completion of the sale of non-core assets including 11 Queens Road and 34 Chandler Street, the fund's portfolio valuation was reduced to 213.7 million. However, the fund subsequently undertook a portfolio-wide revaluation that increased the fund's valuation to $232.7 million as at 30 June 2015. This represents a valuation improvement of 9%, which encapsulates improved property metrics, improved market conditions, and Denison's successful remediation strategies. In June 2015, the fund entered into an unconditional contract to sell 407 Pacific Highway, Artarmon, at a gross sale price of circa $18.5 million, which will net the sale price to $16.1 million after settlement adjustments exclusive of sales costs. The sale settled on 21 August 2015. The net sale proceeds were used to reduce the NAB senior debt and the FARI 3 bond. The profit from continuing operations amounted to $13.9 million for the year to 30 June 2015, compared to 2014 profit of $9.9 million. A majority of the profit is attributable to non-cash items including building revaluations of $16.5 million compared to 2014 revaluation of $13.3 million. Adjusting for non-cash items including changes in fair value of financial instruments and investment properties results in a loss of $1.9 million compared to 2014 loss of $2.2 million. Current market data articulates that New South Wales continues to outperform the other major states. Economic growth in New South Wales is expected to continue in the medium term, supported by low interest rates, rising house prices, immigration and infrastructure spending. Current market data identifies that suburban office capitalisation rates are continuing to compress, which will have a positive effect on property prices within DDPF. Rental rates in the suburban office market remain robust due to an undersupply of competitive stock as well as continuing growth in Greater Western Sydney. DDPF is strongly weighted towards the New South Wales and the suburban office market, which provides positive signs for financial year 2016. When Denison took over the management of this fund in June 2012, the assets were in poor condition with little to no maintenance, and as a result, the value of these properties has significantly decreased. Furthermore, with a relatively high vacancy rate of 15%, and while at only 2.2 years, the fund was in extremely poor financial position and facing loan defaults. Denison's immediate goal when we took over management was to remediate these assets and stabilise the fund, and I believe we have been successful in achieving these goals. These successful strategies provide the catalyst for DDPF to negotiate debt refinancing at a lower, more sustainable cost. This refinance strategy remains Denison's focus over the next 6 months and will assist further stabilisation of the fund through significantly reducing current debt costs. During 2016, Denison's capital management strategy remains focused on refinance of senior debt, refinance of the FARI 3 bond, increasing DDPF free cash flow through the reduction of interest costs, which will provide a significant annual cost saving to the fund, reducing vacancy and continued tenant retention. Denison has identified non-core assets to be sold to reduce the portfolio's debt ratios to more sustainable levels. These assets have been earmarked for sale over the next 18 months. We are hopeful that the implementation of this strategy will potentially facilitate an opportunity for DDPF to recommence distributions in the medium term. We remain focused on distributions as the main outcome for investors in this fund, as indicated to us by investors throughout the investor surveys we have conducted. We once again thank investors for their continued support and invite investors to contact us should they have any further questions regarding their investment in the Denison Diversified Property Fund.